So I'm very excited to be speaking with Reza today, who's very, very knowledgeable in this space. So I'll start by asking you to just introduce yourself and your background.
Sure. Well, very, very nice to meet everyone. My name is Reza Sabahi, and I'm the managing partner at Tellaro Capital Partners. We're an alternative private lender based here in Los Angeles. We are focused on what we call lower middle market companies, primarily US-based companies generating about 10 million up to 250 million in revenues. However, we do have flexibility to provide financing to folks that have more or less. And within that mandate, we're mostly focused on technology companies, consumer products companies, and industrial companies. And our thesis is really grounded in the fact that there's lots of fundamentally strong businesses out there of a variety of stages that just don't have access to bank capital right now. And so we aspire to provide them institutional quality capital. And I also want to shout out my Chief Operating Officer, Joanne Rosario, is here with us, as well as Jordan Dean, who helps us on our data analytics platform.
Great, thank you. And I think also your whole career, you've seen so many different types of capital, so that's why we'll also dive into that. So given that we have a quite wide audience here at Startup Cafe, maybe you could start by just giving a little bit of an overview of the landscape for the different stages from like 0 to maybe around 5-10 million, and what different type of capital might be available.
Sure. When we think about the different stages of companies out there, certainly for most businesses, there are ways to secure non-dilutive forms of capital. And certainly a lot of what we're going to be talking about are ways to get non-dilutive financing so that you can retain more ownership in your business or whichever business that you're participating in. And I think that when we view the smallest companies, maybe your startups, either pre-revenue or just starting out, some of you may know that at that stage, likely the only source of capital may be your personal wealth, net worth, friends and family, credit cards. Some folks may leverage certain of the assets they have. Now, for some of the most sophisticated management teams that do have a track record, they may be able to secure non-dilutive financing even at the pre-revenue or just at inception stage. Some of that's
Can I just pause there? So how many people here have raised capital at some point? Okay, so it's about half. Okay. How many are founders? Okay, great. So maybe also just like what is non-dilutive capital?
So it's getting money where you don't have to give up ownership. And so most of the time it's going to be debt, although sometimes the debt may come with some equity features, but non-dilutive capital is just a fancy way of saying you don't have to give up any equity.
Great. So just sort of bringing down the level here a little bit. So let's just talk about like what the different rounds, and then I would love it if you could kind of talk about how they fit into different stages. So very often, as Reza mentioned, we might start with bootstrapping, right? So what does that mean? It means that you're not taking any external capital, that you might use your own resources, and I am a big promoter of trying to do that for as long as possible. And one of the reasons there is the more value you have in the business when you go out and raise the first time, the less you give up in capital if that's what you get. Then Reza mentioned friends and family. Sometimes it's friends, family, and fools. That's when you're really early stage and you take money in from people you know who just believe in your crazy vision, but you don't have much evidence, not much traction. And then after that, very often it's angel investment. So angel investors are individuals that invest capital, often accredited investors. They are professional, they will do their due diligence, and the checks can be everything from 5K to maybe 100, and then there are some angels that do larger checks, the kind of super angels, professional investors. I would also mention crowdfunding, which I've done successfully, and multi-million-dollar raises has been very fun. And it's like a combination of a capital raise round and a marketing campaign to some extent. It suits certain people. I'm more than happy to share more about that. We're not going to focus on that today. Incubators and accelerators, we've done that successfully a couple of times as well, can really put some extra rocket fuel into the business where you may not have resources, and accelerators, when used right, can provide a lot of that. Then we have VC, and I'll probably ask you a couple of questions about that. Venture debt, which we will dive into later. Corporate venture capital is actually something that we'll mention more about, that I'm kind of interested in right now as well. Revenue-based financing, something that we've also done. And grants, we're not going to cover that, but that's another opportunity. So I think a lot of early stage company people think of themselves as a startup, whether they are or not. So definition loosely is that you kind of need external capital. You have the ability to grow exponentially, but very often people think VC money, but there are pros and cons, right? So can you talk a little bit about where VC funding, the pros and cons, where it may not be suitable, and what the alternatives are at these early stages?
Sure. So you covered a lot of the canvas on kind of the earlier stage. So maybe for the sake of where we are in the conversation, typically when you're getting to VC, not all the time, but you're probably beyond a proof of concept. And in terms of the pros and cons of venture capital, if you will, most of the time, and it depends on where we are in the economic cycle, but most of the time, if you're transacting with a more sophisticated venture capital investor, they are on the margin normally going to require a little bit more in the form of equity than if you are a little bit earlier stage. So going back to the idea of how much of the business are you going to retain, can you retain, that's typically one of the drawbacks with taking on venture capital. Now, one of the benefits is that typically venture capital is very, very patient capital, and it doesn't come with the same level of constraints that you are typically going to find with either traditional financing or even alternative financing like ourselves. Things like covenants, reporting requirements, duration by which you have to pay back all or a portion of your loan. Those are normally some of the trade-offs between venture capital and not taking on the venture capital.
Yeah, great. That's a really good example. So maybe could you dive a little deeper into especially sort of the area of venture debt, and what do these criteria look like in general, and maybe a little bit what you guys look at as well, and compare that a little bit with venture capital in terms of pros and cons.
So when we think about venture debt specifically, if you think about tiers, the most basic tier is you are getting financing for your idea. And in exchange for that, they are normally going to have some form of equity kicker. So it's going to be a debt instrument, but it will normally have some type of equity feature. So that may be dilutive. Above that, if you're a company that has something, whether it's IP or an actual product, the venture loan will secure a lien or an interest in that collateral as it is. And then, of course, as you go up the scale, if you have cash or cash flow, your venture lender, again, a legal concept, will take a lien or security interest against that collateral. So for the most part, especially the businesses that are beyond the concept stage, even your venture lender is going to generally take a security interest in materially all or all of the assets of the underlying business.
Yeah, great. So in layman's term as well, I guess, with venture capital, they take equity in the company, right? So they own a part of your company. And it's very important when you start out when we start out raising, that we plan for how much we're willing to give up on that company. But then you get money and you give a piece of the company away. And what we're talking about here, there needs to be some assets. So can you talk about a little bit what those assets might be? And also, let's see, what type of businesses do we have here? AI, do we have any AI businesses? Yeah. Any food and bev? Okay. SaaS, any enterprise SaaS? Okay. Any kind of wellness businesses? All right. Is any other shout outs? Entertainment tech. Okay, perfect. So what kind of assets, or how can we think about these type of sectors?
Well, lenders are very opportunistic, so they will attempt to take any form of collateral that they possibly can. So if we think about a SaaS company, the preponderance of actual value is the code. So the lender is going to take the code as their security. If you are an ed tech company, maybe you have some hardware component, your lender is going to take your inventory, take that collateral. If you're generating sales, maybe you have accounts receivable, your lender is going to take that collateral. I would say for the most part, most lenders are going to try to take any asset that you have, not necessarily take it as in take possession of it, but in terms of being able to secure their loan against something. Really, it can be anything, and it's going to be situational. I would say that depending on the lender and the underlying business, there's going to be a preference of certain types of collateral. But, going back to SaaS as an example, a lot of times we'll structure those deals as recurring revenue deals where the underlying collateral, it's ultimately a cash flow based financing, but we're underwriting to the recurring revenues of the business in that particular example.
Thank you. Does that make sense to everyone? You get the loan, and then they have a security over something in the business, and that is obviously also if the challenge is obviously things don't go well, because then you can lose your IP, you can lose the whole platform, but otherwise the benefits are obviously that you don't have to give up a stake of the company.
Yeah, but just to add, probably the more important thing within the context of this conversation is that there are so many different forms of collateral, so many assets that you may be able to monetize. Some people don't realize or recognize that their code, as an example, may be monetized or pledged as collateral. Your inventory. So especially nowadays at the frontier for technology in particular, there's lots of different ways to monetize even your idea, if you will. Although to a certain degree, that's what venture capital and venture lending is.
And in terms of what the industry is looking for, a couple of questions here. Both the kind of fact patterns, maybe for the industries that we discussed, how that works. And then also if you could drop a few examples that people might be able to explore in terms of different types of venture debt lenders that you might be aware of for the sectors we mentioned.
Sure. So in terms of fact patterns, I think it's all the common sense stuff. Are you transacting with a founder and or a management team that appears to be professional, that isn't going to do anything nefarious? Ultimately all businesses, we're all in the business of doing business with other people. The idea is great, the company's great, but is there a management team with whom you trust? And then, of course, the underlying business itself. Is it a fundamentally sound business? Is there a reason for the business to exist? What are the trends of that business? And then specifically, when you think about what industry that business is in, what is the competitive advantage of your client, your borrower, your investment? Why do you think that they're going to be around in another 12 months, another 18 months, another 24 months? I think that at least on the lending side, sometimes people try to make it a lot more advanced than it is. It's really, really simple. It's the people, it's the product, and then it's the industry.
It sounds a little similar to venture capital. So, venture debt might often come in after venture capital, right? So what are the differences? Because I would say there are differences when you're eligible for venture debt and when you should go for venture capital.
Probably the biggest difference is duration. It's the time by which your counterparty needs to monetize their own investment. The lender is an investor. It just invests in a different part of the capital structure compared to the equity investor. And so for the most part, your lender is going to want some type of return over a 1 to 5 year period. The earlier the stage of the business, the less the duration, meaning they're going to want to get repaid in a year, in 2 years, or 3 years. And then the more mature the company, they may be willing to wait 3, 4, 5 years to get a repayment. But that's probably in terms of like the return. Probably the biggest difference between the equity investor and the debt investor is just the duration by which they need to get their money back.
And just to drill a little deeper on that to the company, because I think it's very important to understand what are different types of investors looking for to assess, is this relevant for my type of business? So I think there are also differences where, especially very early stage, venture capital are investing pretty much in the team and the idea and the opportunity, right? Whereas typically you need to at least have some asset or something to invest in, and very often it comes after venture capital.
Got it. So maybe another way to articulate it is specifically talking about a venture lender. At the earliest stage, the venture lender may ultimately be underwriting to the next equity round. So the lender at the early stage is just trying to figure out whether the company and the management team has what it takes to raise an equity round, which will be used to pay back the venture lender. That's at the earliest stage. Then the next stage, when you have a company that's kind of sort of doing stuff, the next stage is, do they have actual collateral that I can foreclose on if things go sideways? Effectively, any accounts receivable and or inventory specifically. And in some cases, like in life science, machinery and equipment. And then beyond that, at the more mature or growth stage, once you're beyond needing an equity raise to repay your lender, and once you're beyond needing to rely on accounts receivable, inventory, machinery to repay your lender, are you generating enough cash flow to repay your lender? In the most basic form, that's kind of like the 3 rungs of the ladder in terms of cycle and sources of repayment for a lender.
Great. Everyone following? Great. Awesome. So I kind of have a feeling that the landscape is changing and there are new types of capital coming in. It might just be because I'm more exposed to it, selective perception. But I would love for you to talk about why you ended up starting your firm and what you're seeing in the market as a whole.
Sure. So not our pitch, but we've seen this. My partners and I have seen this, having spent a lot of time within banking. Banks do not want to lend money to non-corporates. If you are Tesla, if you are Meta, you can get more money than you can put in a vault. But for the non-corporates, and even that term non-corporate, a lot of times it implies a large company. Folks that are doing 25 million a year, 100 million a year, you would be surprised at how hard it can be for a company doing $250 million a year to get financing. So that's our thesis. That's one of the reasons that we've done it. But the banks, certainly for the subscale business, even a company doing $10 million a year of revenue, $1 million of EBITDA, $2 million of EBITDA, really hard to get financing. And so
has that changed a little bit?
It's changed a lot. It's changed a lot. I think I can joke about this because I've spent a lot of time in banking, but banks only want to lend you the money you have. And to a certain degree, it's always been like that. But probably the last 10 years, that has accelerated and become more severe and more prominent. Some of that is just the regulatory environment that we're in. Some of that is just banks are under tremendous pressure to generate income in ways that they weren't under pressure before. So the banks have been on a long arc, if you will, of primarily being providers of capital to really wanting to be providers of fee-based services. And that's inconsistent with providing financing. On the other end, some of you may know or you might be reading that there are a lot of private capital providers. What Joanne and I and Jordan are doing, direct lending, lots of folks are doing it. Ironically, some of these folks almost suffer from their own success, and they've become so large and they've raised so much capital that it's uneconomical for them to do the types of deals that we're focused on. And all of that's to say that absolutely in this environment, especially with tariff uncertainty, the rate environment, the last 2 or 3 years has probably been the most difficult environment for non-corporates to raise debt and equity probably since the great financial crisis.
And why do you think that is, apart from what you just said? Other factors that play in?
Let's see, other factors than the...
And do you think that the evolving market is addressing the issue? I think a lot of us as entrepreneurs are feeling the pressure right now. It's extremely difficult to raise funding. And so but I'm slightly hopeful that there is new type of funding coming in. Obviously, the VC model is also quite narrow. I think it's important to address that there's a lot of really amazing businesses that have linear growth or don't fit to the sort of cookie cut VC model that end up not getting financed. So I don't know if you have any thoughts on that.
Sure. Two thoughts. The first thought is, in the current rate environment where rates are high, and if you think about investing being a game of alternatives, what's your alternative? As the risk-free rate is relatively high, it makes it really difficult for investors to chase yield in alternatives like startups. The good thing is that as rates come down, and they will, I don't know how far they're going to come down or when, but as rates come down, startups or early stage businesses as an alternative becomes relatively more attractive. So I think that there will be that in the near to midterm. That's one thing. The other thing, and kind of coupling this with AI, which I think a lot of people are into and interested, as AI becomes more ubiquitous and as the cost of deploying AI becomes less expensive, I think that the opportunity cost to provide unique forms of financing goes down, which then should drive demand into that type of asset class. As an aside, much of what we're doing in terms of our strategy is deploying some proprietary algorithms that we've developed and coupling them with some off-the-shelf data science libraries and software solutions so that we are able, or we think that we're able, to evaluate credited investments more expeditiously, smarter, and in a way that we think is giving our investors a better risk-adjusted return. And I'm sure there are other people that are doing it, looking to do it, will do it. But I think that the proliferation of hardcore AI, advanced AI, will also bring down the cost of capital and allow capital to flow to relatively riskier investments like early stage investments in startups.
Great, thank you. And great segue into you talking about your algorithms and such. What set you apart? And like what type of data is your AI analyzing, and like how a little bit about like what the market and how you're differentiated from other players in that field.
So this is just based on our diligence. Our diligence would present that within the lower middle market direct lending, we're the only firm that has our technology and utilizes AI the way that we do. Again, I have no way to fact check that, but that's what we believe. And effectively what we do is we have proprietary algorithms that we also use with off-the-shelf software solutions. And the way that we use it is if we have a prospect, you want $15 million growth term loan, we're able to get your information, ingest it in a very, very quick manner, in a standardized manner, and in a statistically significant manner to help us evaluate whether or not the opportunity meets our risk and return standards and needs. And really doing it in a very, very advanced way that is standardized, that is repeatable, that you can do very, very quickly.
So what are we talking about here? Are we filling in a form, submitting accounts? Like what does the process actually look like? Because I think a lot of people have not gone through the process.
Well, the process can be very difficult. Our process, we think, is a little bit more streamlined. In its most basic form, imagine giving us an Excel sheet with your last 3 to 5 years of historical performance. I understand that some of you all might be entrepreneurs that have a startup that might not have that. But for the sake of this argument, imagine giving your lender an Excel file with income statement, balance sheet, cash flow statement for your last 36 to 60 months of existence. With that information, almost with the click of a button, imagine, certainly within 1 day, we can build a model at the 95% confidence interval that provides us, if you've ever had statistics, a time series analysis forecasting what we believe is going to be your future. And that gives us the confidence either to engage and say, hey, Joe, we think there's something here. Don't want to waste your time. I got bills to pay. Don't want to waste my time, but we should have a conversation. Or even more importantly, in spite of what the headline might look like, you know what, Anne, this probably isn't for us.
Great. And I would love to hear a couple of examples of smaller businesses that you've helped. I think you're like do tech, consumer, and some general. So if you got a couple of examples, how you assessed them, how they got funding, and what the outcome was.
Sure. Maybe on the more startup side, something that comes to mind is a food and bev startup that we financed about a year and a half ago. They effectively had a coffee product. I won't go into great details, but a coffee product that supposedly produced a really, really high quality cup of coffee that had some optionality. They got in with Starbucks. It was effectively like a pre-revenue business, but they got in with Starbucks, and based on the contract that they had with Starbucks, we used that as our collateral to provide them what ended up being a $500,000 loan for their own growth so that they could roll out this product to Starbucks. So that was like effectively a pre-revenue business. Another one that comes to mind, about 3 or 4 years ago, we did I think a $7 million financing for a entertainment technology business. They are a live streamer of live rock events. And in that case, they did have revenue. They had monthly recurring revenue, so not annual contractual contracts, but a monthly subscription. And we use the monthly subscription as our collateral to underwrite the facility.
Great, thank you. I thought we would just touch a little bit on revenue-based capital as well, because that can go a little lower and earlier stage as well. And just maybe explain a little bit about revenue-based capital and how that fits into the mix and where it might be relevant.
Sure. Revenue-based capital has become very, very popular the last 10 or 15 years with the rise of SaaS specifically. And folks have come up with a lot of really creative ways to use revenue as a form of collateral, if you will, either as like the factoring approach or a cash flow approach to financing. And so what you may find, depending on your company and your revenue model, is that you can use your historical or forecasted revenues to get financing. And there's some folks out there like a Blue Vine, a Cabbage, a Pipe that will do that. In Canada, there's Espresso Capital that will do that. And they'll do that at the smaller end. I'm talking about $50,000, $100,000 financings. And then a little bit upmarket, there's plenty of folks like a Hercules Capital up in Palo Alto or an Oryx in New York. Lots of people will provide revenue-based financing, in some cases in the hundreds of millions or billions of dollars.
Yeah, and that's actually something that we've used, and it's also like very data oriented. So the difference with like early stage venture capital, looking at your projections in your future, plugging into your back end where consumer products. So they would plug into our Meta account, plug into our Shopify account, and just see there what our revenues are, what our margins are, etc. And then they lend based on that. It is expensive, but there are some benefits as well, which is you pay back a percentage of your revenue. So if you're having not a great month, you pay back less, right? So there are certain ways where that can be very beneficial, but obviously anything that you add to your revenues takes out of your margins. So it's just to sort of be aware of those parts. Okay, so I think we name dropped a few. Is there anything else that we feel like people can go and look up and take a look at? Because otherwise I will be opening up for some questions. And, we focus a lot, obviously Reza has incredible knowledge around the venture debt, which I'm also very interested in because it's one of the financing classes that we haven't used. But Reza's worked his entire career in banking. I've raised in a lot of different ways, so we can take questions generally. But just are there any other resources or providers or companies or even like resources for assessment and things like that people can look at?
I'm not going to say anything specifically, but I mean, the last thing I'll say before questions is that raising capital is always hard and debt can be tricky, but there are so many different avenues to raise debt. You can Google it, you can chat GPT it, whatever. There are options. It might not be your first or second or third option, but there are lots of ways to procure debt financing right now.
Great. So let's get into some questions here. I think that's when it all gets real. Yeah, let's start over there.
Reza, as you were talking about how you analyze potential opportunities and the algorithms that you use to go through probably tons of different businesses that are clamoring to get capital from you, what are the few key things that we as entrepreneurs and founders, how should we position our businesses in order to be more appealing to somebody like yourself and businesses like yourself?
Well, I think, first of all, just you, the manager, it gives the lender, the investor, great confidence when they think that they're transacting with another adult in the room. So I think that's number one, as qualitative as that is. But in terms of the business itself, what we try to triangulate is a level of confidence that the business is not going to evaporate in 12 to 24 months. And as silly as that sounds, most of our financings will have a 3 to 5 year duration. I'm just trying to figure out if you're going to be alive for another 12 to 18 months. For the most part, time, ironically, is on everyone's side to right the ship. But for the credit investor, for the lender, one of the worst possible things is you do a deal and within that first year, something goes wrong because then you don't have the benefit of time. So in terms of the quantitative aspects of the deal, just trying to build a mosaic that gives the lender some level of confidence that you're going to make it 12 to 18 months. Beyond that, who knows what the world looks like, but at least our firm and most of the firms, and we've been at some very, very large global firms, that's what we're trying to figure out.
Good morning, everyone. I am Vera Kopp. I'm CEO of Incast. We are influencer marketing agency and building a platform. I'm very interested in knowing more about the lending against a contract and what the proportion would be. So let's say we have a contract with TikTok for 10 million. How much money can advance to execute on the contract and the terms-ish?
That's probably a longer, larger, a more robust conversation. But shooting from the hip, if you're talking about contracts with TikTok, I'm sure you could find 10 people between here and the 405 to give you at least 85 to 90% of the face value of that contract. Again, having known nothing else about it, but when you're talking about large companies that have a contractual obligation, and of course, I don't know what your obligation to perform is, but if you're talking about contracts with like TikTok, Meta, whomever, I would find it very hard to believe that you won't find a lender at fairly attractive rates to provide you that financing. But happy to discuss that further.
And so, what should people look out for? Because there's obviously there are good operators, not so good. What should people really focus on when they assess different lenders, and what should people look out for?
Not the most technical answer, but the inverse of what I was saying. What's your vibe with the lender? There are a lot of lenders out there, but ultimately, we're all in the business of people. The guy or gal that you're dealing with, how do you feel about them? Are they going to be an advocate for you? Just like any relationship, you have your ups and downs. Even the best businesses have their down years, their down quarters. How do you feel about the individual that's going to be your advocate inside their firm? So I think that's what's most important. But then above and beyond that, just doing your own due diligence, the same you would if you're going to buy a watch or a car. What are people saying about that firm? Do you know anyone else that's got financing from that firm? Is the firm growing? Is the firm shrinking? We live in the information age. You can get that information fairly readily.
And how common is it that you get everything up front, or you get things in tranches based on deliverables and criteria?
It depends on the financing. For what we do, we're primarily providing term financing. So you're getting that nugget all up front. You're getting a lump sum. For a lot of forms of financing, especially with the banks, and like your example, what it's normally going to be is a revolving type of financing where, depending on the underlying collateral or contract or revenues, drip, drip, drip. You'll get a little bit now, got to pay it back. Get a little bit now, got to pay it back. You grow, you get to borrow more. You shrink, you get access to less capital. So it's really going to depend on your needs, your collateral, and the use of the proceeds.
Yeah, so I think those are also things to consider. And with all of these things, always ask ourselves what could go wrong and am I happy with that outcome? So in a sunny day where we hit all our milestones and everything goes well, great, but really assess the level of confidence and the level of understanding of what they're lending against, etc. So I think those are great things. Yeah, we got a number of questions back there. I see 3 hands.
Hi, good morning, everyone. My name is Adil. So I have a question. I have a healthcare company back in Asia, and I do have a healthcare company in here as well. And I was just wondering, ventures like you, how are you interested to invest in companies which are, or in typical ventures like you, how are they interested in investing in companies which are outside the US, most particularly in Asia?
It's difficult. It's difficult. We really, really rely on legal infrastructure to have the confidence to be able to deploy capital. And so common law countries, the United States, the UK, Canada, Australia, historically Hong Kong, although less so now, a little bit easier for a lender because of our confidence that we're going to be able to execute and exercise our rights and remedies if needed. Outside of those countries, in general, it's tough. Even in parts of Europe, Asia is very, very difficult. Joanne and I, we've worked at some very, very large global firms, and even JP Morgan, Goldman Sachs, Wells Fargo. It's very difficult to lend money in Asia, Eastern Europe, Africa. Not impossible, but very difficult. And the only other thing I would say is that if it's at the corporate level, certainly it becomes easier because of the scale, but for subscale companies, very, very difficult. I think that India in particular is becoming more mature, so I think there's more risk appetite in places like India. So there may be some nuances. There may be some idiosyncrasy where onesie twosie you might, like in India, a Singapore, but it's tough. And certainly our strategy is specifically domestic, almost all US based. We may do some stuff in Canada, but our strategy is domestic, and even much, much larger firms, real tough to do a loan in like Asia, Eastern Europe, Africa.
What stage are you at?
We're making money.
You're making money, okay.
Yeah.
Because there are venture capital firms, obviously, that invest also international, and India is a growing market. It is maturing. It's also growing as its own ecosystem. I definitely know that Expert Dojo, a local VC firm or accelerator, they invest in India. So I think there are different avenues. There's obviously private individuals as well in the industry, but probably from a lending perspective, for the regulatory reasons, it's a little bit more challenging. Thank you.
Thank you.
But there are lenders in India. I mean, certainly I have colleagues that are lending in India, but just in terms of cross-border, if I could use that term, probably less so. Not impossible, just proportionally less.
Yeah, because I have a home healthcare company here in the US, in LA, and I have a home healthcare company back in India, and the growth is phenomenally good over there compared to what is over here with regards to the acquisition of customers and all those kind of things. So that's and I'm like more interested to have money raised there than here. Because here it seems more stagnant, but there it seems more growing. So that was the question for.
You got a company here, you got a company there, you're dressed all nice. What do you need all this money for? Another Patek?
Actually, to get tech inside, yes.
Growth.
That's right.
Hi, thank you for being here, first of all. So I understand film lending better because I've done a lot of that. I've done like 40 films. Those sometimes go sideways because for a whole lot of reasons. I don't know what your, first of all, extendable point is after your term, if it's not going somewhere. If you're basing it on IP, which is kind of the same thing, and I can tell you've done things like that before. It's obvious from the way you're talking. Bankers look at things differently. They look at things not as an investment, but as collateral, like you said. So in that scenario, if you take debt versus equity, what's been the percentage of ultimately foreclosing on your loans versus extending them, and what are your criteria? Because as my experience is that bankers will always fall back on bankers, and that's kind of the point of view you're taking.
Sure. So I'll try to unpackage that, a couple, 2 or 3 different questions in there. So number one, in terms of extending, these loans are investments. It's an investment. It just happens to be a loan. if we have a client that's performing, we want to extend as long as we can, because the longer that loan's outstanding, the more money we're making. Now, of course, the opposite's true if it's not performing. If your loan's not performing, you might have 3 years left. I want my money back today. So to the extent that we're willing to extend, lots of situations where we're willing to extend, most of the time, the loan never gets repaid. The loan either just keeps getting extended or trades hands from one lender to the next. So in terms of extending beyond the original maturity, that's situational. In terms of bankers, and I'll make a nuance between a banker and what we do, bankers are about collateral, and that's driven by regulation. That's not their fault. There's lots of good bankers out there. But the banker and the banks, because of regulation, they need collateral. So a banker's default is always going to be collateral, accounts receivable, real estate, inventory. What we do, of course, we do look at the underlying collateral, but in a very simple way, we're enterprise value lenders. Yes, we need to know what collateral is available if we need to foreclose, but when we think about foreclosing, we're normally thinking about either taking the keys to the Cadillac or selling the business to repay our obligations. And so I just want to punctuate that nuance that bankers, the regulated lender is very much about collateral. The unregulated lender, the alternative lender, the private lender, private credit strategy is really an enterprise value lender more so than a collateral lender. And then the last part of your question, in terms of foreclosing, you hope you never have to do it. I'll tell you right now, bankers absolutely don't want to foreclose. That's like the last thing they want to do. That's like a nightmare scenario. Bankers and banks are not set up to take ownership. Most of the time, I mean, default rates, you can default on a covenant, but that doesn't mean that your lender or banker is going to take over. Most of the time, it means that you guys come to the table, you know, you have a come together moment, figure out how to move forward. But even in very, very severe economic downturns, I think that foreclosure rates, and I'm not talking about mortgage foreclosures, I'm talking about business foreclosures. I mean, it's typically less than 2.5%. 2.5% would be like GFC type percentage. I think normally loss rates for regulated banks, something like 0.35 basis points, really, really low.
That you sort of base it on.
So our strategy tries to net our investors 9 to 11%. And I'll unpackage that myself. So our strategy, what we're trying to do, going back to this concept of banks not wanting to lend money, what we tell our investors is we're trying to create what I call is a synthetic portfolio of bank loans, but not a bank's risk appetite today, what a bank used to want to do 5 or 10 years ago. And so on a risk-adjusted basis, we think it's a good trade, but on a relative basis, we think that we have a higher quality credit, but in exchange, relative to some of our competitors, we have a lower nominal rate. So where we try to target 9 to 11% net to our investor, there are other credit strategies that we might compete with that are closer to 12 to 15%. And then, of course, a bank in today's environment is going to be something like 7.5 to 9%.
Hi, let me step out of the shadow so you can see me. Hi, I'm Andrew. We're an AI startup. We build a synthetic workforce automation platform. There's 4 of us right now. We're doing about $2 million a year. We have a product in market and we have customers and we need to scale. And my question was, is there a reason why debt financing or some other vehicle might be better than a traditional sort of raise and equity round?
I mean, it's better because it's non-dilutive, but it's going to come with some strings attached. If you're talking about, I think you said 2 million of revenue?
Correct.
Yeah, 2 million of revenue, like the oyster starts opening up in terms of your optionality, what's available to you. So again, shooting from the hip, I suspect that you do have options for financing, but your trade-off is going to be that financing's likely non-dilutive, that's great, but that financing probably comes with things like monthly or quarterly reporting, monthly or quarterly compliance. Your lender might ask for some type of a guarantee from you and or your founders. So that's the trade-off. It just depends on the premium you assign to some of that structure. Maybe that structure is too great, you rather dilute yourself, or you're willing to take the structure for the lower yield. That's a decision you have to make.
Thank you.
And I would say as well, just consider what type of a venture capital investor, because it's so different. Maybe you might want to correct me, but that venture debt aren't that involved in supporting and helping and working closely. It's kind of a little bit more towards the banking in terms of pure finance. Whereas obviously some strategic investors or some VCs that are also going to do your future rounds and have a lot of additional support. So I think there's so many different things to think about in terms of the capital choices.
Yeah, I mean, you said it well. That is a big thing too, especially at the early stage. What is the value that you get from your venture investor in terms of operational excellence, ideation, access to potential customers and markets you wouldn't otherwise have? I mean, certainly that has to go into your options analysis too.
Well, first, thank you very much for a very informative overview of alternative financing. And also for using quantitative and at least systematic approach to evaluating these startups. I'm wondering though, because early startups by definition don't have a great track record, and also they're hoping or shooting for accelerated growth, the past may not be a good proxy for the future. So whatever your algorithm is analyzing may not be a good projection of where they're going. And also, I presume that you're using generative AI or large language models when you say you use AI models. If that's the case, I'm wondering then how you deal with the cons or shortcomings of these structural shortcomings, like, for example, hallucination, that they may give results that are totally bogus in evaluating these companies.
Sure. So thank you for your comments. We're not that slick. We're not using large language models. Very much what we're doing is effectively using statistics to do our time series analysis. And yes, there's AI and ML, but we're not using large language models. We're really deploying the technology as a means to standardize, create systematic approaches, and then just be time efficient. You're also correct that our approach would not be well suited for evaluating early stage businesses where the historical information would likely not be a good indicator of the future. This is not my area of expertise, but having friends and colleagues in venture capital at some of the larger firms, they are building out their own models. But for the most part, the way that they're building their models is really regressing, if I can use that term, a statistical term. They're regressing factors against the founders and the management team more so than the underlying business. Of course, there are ways to build a model where you can try and mosaic future potential of an idea, but it's very, very difficult. But to the extent that at the early stage, firms are using these types of models, it's more so around the founder, the founders, and or the management team.
I think it's a good comment that kind of summarizes a lot of the differences that very early stage VCs will look at your vision and where you're going and hope that you're assess how much they believe in your projections, and that there needs to be some historical data that can validate that pretty much when you're looking at venture debt, right? I think that's
Yeah, at least for what we do. And even that term venture debt is a very, very amorphous term. I would tell you that we've done venture deals that are in the hundreds of millions. You can do a venture deal that is like a couple 100,000. So the term itself can mean lots of things to lots of different people. It just depends on the circumstance and with whom you're talking.
great. I did see a few more hands. Great.
Hi, Reza. Thank you. Quick two questions. First one is per the gentleman with the AI and generating 2 million, presumably ARR. If that sort of traction with a firm and you're in discussions with them, granted that equity capital would kind of take a chunk of ownership of their firm, but you also just mentioned 5 minutes ago that there'd be potential marketing and business development benefits based on who the equity participant is. Question is how much have you or your firm seen yourselves competing against equity for the type of firms that have that sort of traction, not necessarily 2 million a year. Second quick question is just that question. I forgot the second one.
Well, if you think about the next one, you could throw it out. That happens to me all the time. We don't find ourselves competing with equity, rarely, if ever, and that might be a function of just the segment of the market that we're normally transacting in and our normal use of proceeds as well as our risk appetite. So I would say that we effectively never compete with equity, but I have a number of colleagues, met with a colleague of mine yesterday where he probably competes a lot more with equity. And I would say, at least within the private capital realm, where we find the lenders competing with equity is when you are trying to put together a structured product. So let's say you can float equity and dilute yourself where the rate of return for the investor is like 22%, or you can go get a convertible debt instrument where the combination of the interest rate and some warrant or equity kicker is an implied IRR of like 18%. And then that's where just the difference between where your lender is going to be with their equity kicker and where the pure equity is just your options analysis on what the value of either that investor is and or the value of not diluting yourself. Sorry if that was overly technical.
No.
I didn't mean to be overly technical. But the point that I was trying to make, no, we don't compete with equity investors, but there are plenty of private credit strategies that do.
Yeah, I remember the second one very quickly. Like, how much of your modeling is kind of macro in the sense of you're looking at this startup and then you're weighing it against like wherever the puck is playing on the ice over the next 5 to 7 years? Or is that not in your calculus? You're just kind of purely going off of performance metrics?
It's both. So again, not to nerd out on statistics, but in terms of our modeling, we will regress against exogenous factors, macro factors, if you will. Sometimes the downside of that, for any of you that have had modeling, is you can overfit, as it's called, or have a hallucination, to use an AI term. But we do bring in exogenous factors. We also auto-regress, meaning look back at the historical information that's only firm-specific. And fortunately, going back to this idea of data science, AI, there are a number of pretty off-the-shelf, simple tools that allow us to do that very cost-efficiently and time-efficiently.
Hi, good morning. My name is Philip Imokpari. I'm founder of BAF. We're building Africa's first credit card network, similar to like Amex and also like Square. As a banker, I'm curious, Reza, like, what would you do differently in terms of like today in like a strategy for credit-based lending and even like unsecured lending? How would you approach this today?
I mean, selfishly, I would approach it like we are approaching it, just deploying technology. I guess if I were to do it any differently, if we had a larger pool of capital ourselves, I think that I would just deploy more technology, more sophisticated technology. I mean, that's what I would do differently. I suspect, and you use the term bank or banker, which we're not, we have been. I suspect that it's only a matter of time until the banks deploy more of this technology. As an aside, I keep thinking to myself, obviously the banks can deploy more technology today. I think that there will ultimately be some regulatory constraints to doing that. I don't think that the regulators want the banks to be run by a bunch of bots and agents. Also, not a political comment, I think that the government doesn't love losing all of that wage tax revenue. So I think there's going to be that as well. But it's only a matter of time. If not today, tomorrow, next year, next month, whatever, there is going to be more technology deployed, of course, across all of the economy, but certainly across banks to standardize the approach which they take to do that type of investing or lending.
And to fully nerd out on the data, do you have data on how well your statistical model is performing compared to other less sophisticated benchmarks? Are you getting lower default rates, high return rates? What's going on? Is it working?
So a couple different concepts there. I think I'll take the largest concept in terms of performance. What we find is that typically our performance is going to be around 2.5 to 5% variance, which if you are in pharmaceuticals, if you're doing cancer research, that's garbage. But for our purposes, and I think I saw someone with an Umpqua Bank shirt, maybe there's a couple bankers in here. At a bank, if you're only off by 5%, you're a rock star. Bank underwriting, even at large private credit strategies, if they're within 10 to 15% variance, they're happy. Most of the time, and I don't know if this is a big secret, but most of the time at a bank, even a large investment bank, as long as their variance isn't greater than 20%, they're not in the penalty box. So what we've tried to do with our technology, I tell the team that 10% isn't great. We can live with a 10% variance, but for the most part, we're going to be 2.5% to 5%. For situations where we have lots of historical and granular data, we can be inside of 2.5% variance. Which again, if you're doing cancer research, that sucks. If you're just doing loans for a Joe Schmo, an industrial company, it's pretty good.
How important is it for the projected use of funds? Because there's a lot of businesses that want capital, and I don't know how detailed you need their projected use of those funds to try to right size the deal.
It depends. I would say one of the places where the private credit lender has more flexibility than the bank is on use of funds. For the most part, not always, but banks, they just want to allow you to use the capital for working capital and or for growth. And that's kind of sort of the bank use of proceeds. For the private lender, you have more flexibility. For example, right now in this economic environment, lots of folks want to take out dividends or do share buybacks. And it's really ironic because within the public markets, you see a lot of it, but within the private markets, banks hate share buybacks and dividends. We got no problem with share buybacks and dividends. And in terms of sizing the loan, it's less about the use of proceeds and more about what's the historical performance of the business, what is my leverage attachment point, and where do I think I'm going to be attached going forward. And then all of that is part of this idea that we're very much enterprise value lenders. What's the value of the business? If the ice cube starts melting, what do I have when I have to sell it? And is that enough to get my money back?
Thank you, guys. I guess we'll try to wrap up here. And I think we learned an enormous amount. I think the consensus is that there are loads of different types of funding, many that we didn't cover here, but we really wanted to take advantage of Reza's knowledge here on things related more on the debt side. That there are, as we mentioned, crowdfunding, incubators, all sorts of other things, and that really we need to look at what are our assets. And one thing that is interesting, just as a comment on a lot more of the data-driven and algorithmically driven analysis, is that I would say that probably the strongest determinant of the success of a company is the founder's psychology, having the resilience, finding new solution, pivots when it needed, getting through crisis. And so those are things that will be interesting to see, because a lot of the talk as well about actually getting to know the person. There's a real person-to-person element. We also see people investing more in companies that they think are actually doing something good and useful in the world. So there are new types of funds, new types of debt also, but some are very interesting. Also, as I mentioned, the revenue-based debt that we have used successfully multiple times. So I just encourage everyone to let's learn more about all these different types of funding, understand that the landscape is growing, and create some great businesses and make sure we find good matches with our funding. Any closing words from you, Reza?
No, not at all. Thank you all for your time. I mean, we're around. You could hit us on LinkedIn, whatever. We're very, very accessible.
Amazing. Thank you so much.
Thank you.
It's very